Hey everyone, this is Kirk here again from Option Alpha, and in this video I want to walk through a concept called filling the gap, or a fill the gap concept. You often hear this with people when they're doing videos or charts or even writing about stocks that have this gap that occurs, and they might expect that the gap is filled or that the gap might be filled potentially in the near future. And so it can sometimes be a little bit confusing exactly what they're talking about. So I want to walk through what it is here on this video really quickly to help you guys understand. So in essence, what happens is you have a stock that's trading along and it's moving, just how it regularly moves, maybe straight or in, some zigzag fashions. And essentially what happens is the stock gaps lower potentially, or potentially gaps higher. Could happen in either direction, but the stock makes a gap in price. And we've gone over this in other videos, but it's just caused by basically a dramatic repricing in the security that happens overnight or instantly based on new information. And so now the stock is trading at a lower price, and it creates this gap in the pricing chart of the security. What people are talking about when they talk about filling the gap is the idea that at some point the stock might come back up and retrace this entire move and close the gap. Now, what's funny to me is that actually the gap can never be essentially closed. The difference here, which to me is really the gap in price, that can never essentially be closed. But what they're talking about is they're talking about the security's price coming back up and essentially closing the gap, or the difference between the price here where it was before the new information and the price here after the new information, that difference being closed and coming back to the same price. That's what they would describe as filling the gap. Now, this can take many shapes and forms. This can happen after a big move lower and then it can come back up. It can happen almost immediately. It can almost close the gap and then move back down. There's a lot of different ways in which it can happen for particular stocks. It can also happen in reverse. So a lot of people will assume that when a stock has a breakout and gaps higher, that it might fill the gap in the opposite direction. So let's assume that stock is moving and it's trading here, and then the next day it trades at a new price, maybe because of earnings or whatever the case is, great information from the company. And so they'll say, okay, look, I think that the stock might fill the gap, and that's an opportunity potentially to get back into the shares. And so they'll look for the stock actually to come back down and fill that price before it continues to move higher. So that's essentially what it is. It's not that the stock actually makes and retraces that entire gap move in the same day, but rather that over time, the stock might fill this gap price. It might explore all of the prices between those two major prices before continuing on or reversing or going the opposite direction. Now, it's important to note that not all stocks, one, either fill the gap, or two, that the gap is a means to reverse the stock position or a retracement of the stock. Oftentimes, the stock might go right through and continue moving lower, just as much as it might hit that gap or somewhere around there, and then continue to move the opposite direction. So there's nothing to say that these are totally foolproof in either direction, but it is an interesting thing that does happen quite often actually on a lot of securities and ETFs, where you have a gap and then you have the gap eventually get filled. So hopefully this helps out. As always, if you guys have any questions, please let us know. And until next time, happy trading.